Hi everyone, welcome to another NPV past paper question. So today we are going to discuss the past paper year 2020 paper 2 question number 6 part B. This is a 10 mark question. So what are the requirements? Schedule of cash inflows and outflows of the project and NPV calculation and the recommendation. So let's read the scenario. Malik Laboratories PLC is considering to replace the old medical testing equipments with a modern testing equipment. If they decide to acquire this new equipment, the old equipment can be sold at a book value of 250,000. So what they are telling, if we purchase the new asset, we can sell the old asset for 250,000. So this is a cash inflow which is going to happen in year 0, because by selling the old asset you will get money. So it is cash inflow. Next one, purchase price. So this is a cash outflow for the year 0, cash outflow. And transportation cost. So you have to transport the new asset if you are placing that order, if you are purchasing the new asset. So this is a cost that you will incur because of the investment. So this is also year 0 outflow. Why here I am writing inside the brackets? Because when I am doing the working, then I know these are cash outflows. This is a cash inflow. Installation cost. So if I proceed with the investment only, I will have to install it. So this 75,000 also a cost I will incur because of the new investment, incremental cash flow. Residual value of the equipment at the end of useful life of the asset. So this particular project is there for 5 years. Then by selling the asset at the end of the project, by selling the asset, I can get money. So this is going to be a cash inflow for the year number 5. Additional working capital requirement at the beginning of the project. So we have to incur some working capital cash outflows. So here when I am starting the project, the purchasing of the asset is not enough. When you start the project, for the working capital purpose, to make the payments for your labor, for the material, you need money. So in order to incur some expenses for the working capital purpose, I have to give money. My cash is going out. How much is that? 275,000. Beginning of the project itself, I have to give it. But what you have to understand here, see, additional working capital can be recovered last year of the project. So this 275,000, yes, I will give. But once the project is over, I can get whatever the money that I gave for the working capital purpose. So there is going to be a cash inflow because of this particular transaction. The expected useful life of the new equipment is 5 years. If the new equipment is purchased, the annual increase in the profit. So they have given the profits in this question. How much is that? 210,000. Normally for the NPV calculation, we are taking the net cash flows. We are not taking the profits. So how to find the net cash flows? You know, net cash flows equals profits plus the depreciation. So how this particular formula is constructed, I actually discussed this part in a different past paper question. So once this video is over, in the end screen you will be able to see a past paper question. Once you click it, in that past paper explanation, I have given you how they have constructed this particular formula to get the net cash flows, profit plus the depreciation. So here do remember, for this 210,000 we have to add the depreciation back. So this is the annual cash flow annually. Each year it is 210,000. Okay. The required rate of return is 10% and the discounting factor to the nearest 2 decimal places they have given. So let's prepare the schedule for the inflows and outflows. So you can put down the format here. So this is the question number 6, part B. Part B, requirement 1. I'll take the cash inflows. So normally you will have 4 types of cash inflows. What are the 4 types? Cash inflow from operation. cash inflow from operation. Another cash inflow is residual value. By selling the asset at the end of the project you can get some money, and by selling the old asset, sale of old asset, it is the another cash inflow that you can get. Then once the project is over, whatever the money that you are giving for the working capital purpose, you can recover it back. So recovery of working capital. So remember, four items are there: cash inflows from the operation, residual value, sale of the old asset, and recovery of the working capital. And by adjusting all these things you can get the all the total cash inflows. Total cash inflows. Total cash inflows. Now I'll take the cash outflows. Cash outflows. So normally what are the cash outflows that you will have? The purchase cost of the machine, purchase cost of the new asset, and the working capital pumping, working capital. So before writing the working capital, it's better if you can write down the installation cost and the transportation cost. So transportation cost, installation cost, then the working capital pumping. So these are the four items. Normally you will get it under the cash outflows. So once you take the total of this, you will get the total cash outflow. So from the total cash inflows, if you deduct the total cash outflows, you will get the net cash flows. So here in this particular question you have 5 years: year 0, year 1, year 2, year 3, year 4, and year 5. So let's go to the question again. Let's take one by one. So this 250,000, it's a cash inflow. So I'll put a tick for this. Cash inflow by selling the old asset, 250,000. That is done. Purchase of the new asset, 1,800. So purchase cost is 1,800. It is the purchase. And next one, 200 transportation cost, installation 75. Transportation 200, installation 75. So we are done with this, we are done with this. And residual value 125, it's a cash inflow. Residual value end of the project 125 cash inflow, that is also done. Then working capital, year 0 it's outflow, end of the project inflow 275. So working capital 275 outflow, year 0, end of the project inflow 275. And apart from that we have the last adjustment. So we are done with this, the cash flows from the operation. How to get the cash flows from the operation? For the profits you have to add back the depreciation. So here they have given the annual profits. How much is that? 210,000. So here you can do the calculation in two ways. One way that you have for the profits, for the total profits, you can add back the total depreciation and you can divide it by the number of years. That is one way. Another way is you can directly calculate the yearly cash flow. So here I will do it for a year. Profits are 210,000. What's the depreciation? So how to calculate the depreciation? Cost minus. So I'll do it here. Cost minus. So what's the cost of this particular asset? When you are calculating the cost, do remember always you have to consider these three only: purchase cost, transportation cost, and installation cost. It is 2,075,000. So 2,075 minus, what is your scrap value of this particular asset. If not the residual value, we will call it as, it is 125. Useful life of the asset is 5 years. Then 2075 divided by minus 125, 1950 divided by 5. So the value that I am getting 390,000. 390. So this is the depreciation per year, which is 390,000. Then here what's the value that I am getting? 600,000 is the cash flow each year. Cash flow, net cash flow from the operation per year. So this is one way of doing the calculation. If not, you can take the total cash flow and do net cash flow equals profits plus the depreciation. So profits 210,000 is for a year. 210,000 is for a year. Likewise, how many years are there? 5 years are there. 210,000 into 5. So the total profit that I am getting 1050. So you can add back the total depreciation. So what is the total depreciation? If not the depreciable value, 2075 minus 125. 2075 minus 125. That's the total depreciation 1950. Then what's the total cash flow that you are getting? 1950 plus 1050. It is 3000. So this is the cash flow that you are getting for the entire project. Then on average, this is a 5-year project. What's the annual cash flow? It is 600,000. 600,000. So in this way also you can do the calculation. You are getting the same answer. Somehow from the operations by doing the business operation. Now these residual value and all, it is not doing your business operation. You are not selling machines to people. You are doing some medical item project only you are doing in this particular scenario. So selling the asset is not your business. Okay. So normal business operation is generating you how much? 600,000 annual. So here let's write it 600,000 every year. 600,000, 600,000, 600,000, 600,000, 600,000. Then let's get the total cash inflows. Total cash inflows for each year. 250,000, 250,000. Here 600,000. Here 600,000. Here 600,000. Here 600,000. Here how much is that? 600 plus 125 plus 275. I am getting a value of 1000. So these are total cash inflows. Let's take the total outflows. Here 1800 plus 200 plus 75 plus 275. I am getting a value of 2350. 2350. Remaining years nothing. Remaining years nothing. The value is going to be 0. Value is going to be 0. So now let's take the net cash flows. From inflows, if you deduct the outflows, you will get the net cash flows. So here plus 250. These are negatives, cash outflows, minus 2350. So here net cash flow negative 2100. So here it is 600. Here it is 600. Here it is 600, here it is 600, here it is 1000. So I think we are done with the first question. In first question, what are they asking? Schedule of cash inflows and outflows of the project for each year. Next, what they are asking us to calculate? They are asking us to calculate the NPV. So how to calculate the NPV? You have to multiply your cash flows, net cash flows from the discounting factor. So let's go to the question number 2. Let me write the net cash flows. Net cash flows. Net cash flows. Year 0. Year 0. So I'll write it here itself. Then I can take the values easily. Year 0, 1, 2, 3, 4 and 5. Then here it is 2100. Negative 600, 600, 600, 600, 1000. So you have to get the discounting factors at 10%. Always year 0 discounting factor is 1. So let me take the discounting factors for remaining years. Here it is 0.91, here it is 0.83, 0.75, 0.68, 0.62. So let me confirm whether my numbers are correct. 918375, 918375, 6862. 6862, yes. So now let's get the present values. Here it is negative 2100, 600 into 0.91, it is 546. Here 600 into 0.83, 498. Here 600 into 0.75, it is 450. Here 600 into 0.68, 408. Here 1000 into 0.62, it is 620. Then what's the NPV? What's the NPV that you are getting? This is a negative one. Don't make mistakes. 2100 negative plus 546 plus 498 plus 450 plus 408 plus 620. I am getting a value of plus 422. That means 422,000 because we did the calculation in thousands. So part 3 of the question, what they are asking, the recommendation. So you know, if the NPV is positive, if the NPV is, I'll write it here, if the NPV is positive, NPV positive, accept it, accept. NPV negative, reject it. So this is a positive NPV, so you can write the recommendation. Since the NPV is positive, it is recommended to proceed with the investment. So this is how you can do a NPV calculation. As I told you previously, if you want to get the knowledge of how the net cash flow is calculated by adding the depreciation for the profit, and if you want to check more NPV past paper questions, you can click whatever the videos displayed on the screen now.